I always like to say is the way we engineered this deal, we buffer in a lot of safety nets and a lot of contingency plans, because if we don't have to worry about those things happening, all that's going to do is just over deliver on what we promised our investors in the IRR.
Let's dive right into some of the particulars. Like, let's say somebody, A, do they need to be a accredited investor one way or the other?
Yep.
Right. B, let's just use if they put $100,000 in and let's just imagine they had a zero gain. Let's say they bought cryptocurrency for $1 and it's worth 100 grand and they just sold it a couple days ago and they're like, oh my gosh, what am I going to do with all this tax? Matt, can you kind of walk us through that scenario?
Yeah. So obviously, we always preface our disclaimers. Obviously, talk with your CPA, your accountant, your tax advisor. With that being said, let's say you've got so we wanted to engineer this deal in a way. We're big on under promising, over delivering. One of the things that I think is plaguing the syndicator and developer world is over promising your LPs on a pro forma. What their equity multiple is going to be, what their IRR is going to be, what their cash on cash is going to be. And we wanted to make sure that if we're going to take this out, and raise this capital, that the deal itself stood on its own, whether you were putting in capital gain money or not. Just traditional equity does this, kind of hit the return threshold that most, savvy investors and LPs would look for. So our minimum investment is $100,000. So I'll just use that as kind of our rule of thumb here in this conversation. But in that respect, if you were to just put in, traditional equity into this deal, it's going to be about a 22 to 23% IRR. Now, the unique aspect of an opportunity zone is you're in it for 10 years. So that is one aspect that is a little bit of a different caveat that some investors are used to getting, in and out within a 5 or a 7 year time frame. However, we engineered the return of capital schedule to be a little bit more favorable, weighted on the front end because of what I'll share here in a second. So if it was traditional equity going in, to be about a 22% IRR. You throw in your capital gain, equity into the deal, right? That's going to significantly juice your IRR. You're not going to be paying that money to Uncle Sam, right? You're going to be able to go and get a return on that money instead of it seeing it, slip through your hands. So that would put it in the range of a 30% IRR. And what I always like to say is, the way we engineered this deal, we buffer in a lot of safety nets and a lot of contingency plans, because if we don't have to worry about those things happening, all that's going to do is just over deliver on what we promised our investors in the IRR. But we wanted to bake all those things in to be extra careful. So we're talking about, right, all of the issues that we have going on with, materials and labor. We significantly increase those prices. I mean, drastically. Where it's beyond worst case scenario, and we're still feeling good about where those are at. Our construction timelines, because we're doing development, right? So this is going to be something that we have to deliver a product, get the product operating, and then part of our return schedule is making sure that in year 3, once we're vertical and we go for a refi, we're returning 3% based on our pro forma of initial equity contributed. So you'll get, let's say that 103, that 100,000 that goes in, you're going to get about $103,000 back, de-risk it, and then our 8 pref kicks in until year 10. So that is something that we wanted to make sure that we were kind of allowing our investors to take some chips off the table. Whereas maybe in some other syndication opportunities, right, you're maybe going to see a 12-month seasoning period and then distributions might start. So that was something we knew we had to kind of play around with to make it a little bit more appetizing, because there's patience and there's also risk, being fully transparent when you're dealing with development. Interest rates, right? Or debt financing, some of these things that are somewhat out of our control, but making sure that we're baking in very conservative and careful numbers into our pro forma to make sure that, hey, we think we're going to be well below these things, and let's make sure that the deal still stands on its own with these things being in there. So when you said diamond in the rough, it really does feel like that to us. We feel very fortunate that we are hitting kind of a stride and also going to be delivering product at a time when we think the market is going to be well underserved and craving a very unique boutique hospitality product. So that's something that, we are all taking into account as we model out this construction schedule. And we're just about there to be breaking ground on this opportunity by next February. So the
Phenomenal.
shovel and groundwork going in is
Mhm.
going to be something that we think, Q1 will be right there to see this project moving forward.
Absolutely, Matt. It's amazing.